What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. Cathie Wood is perhaps the single most polarizing figure in the stock market today. Throughout 2020 and 2021, she's achieved something close to godlike status among many retail investors. She built her reputation on an incredibly successful investment in Tesla, and many believe that she'll be the one to identify the trillion-dollar companies of the next decade. But with the prospect of great returns comes the reality of great risk. Her flagship ARK ETF has given up more than all of its pandemic gains and has significantly underperformed the S&P 500 since the end of 2019. Much of this disastrous performance has come from Wood doubling and tripling down on speculative, money-losing companies, even as their stock prices are falling 60, 70, and in some cases more than 80%. The most extreme example of this has been the telemedicine company Teladoc. Since its peak in February of last year, its share price has fallen by a gut-wrenching 88%, making it a near total loss for investors. As the price declined, Wood continued buying shares in almost all of her ETFs, including her flagship Innovation ETF, her Next Generation Internet ETF, her Genomics ETF, and even her FinTech ETF, despite the fact that Teladoc is not a FinTech company. ARK is now the single largest shareholder in Teladoc, owning 12.5% of the total shares outstanding. Last week, the company reported first quarter earnings results, which were a complete disaster, and the stock price was cut in half in a single day. Despite having already lost hundreds of millions of dollars for her investors on this stock alone, Cathie Wood is completely unfazed. She still thinks that Teladoc will be a 10-bagger and even has the potential to have Amazon-like returns. In this video, we'll look at what Teladoc does, why its share price is down 90% from its highs, and whether it has any chance of being the Amazon of healthcare like Cathie Wood thinks. Teladoc was founded all the way back in 2002 by two doctors in Dallas. Here's the idea. Let's say you have a sore throat, a pink eye, or some other type of minor ailment. You could drive all the way to the hospital, wait in the reception room for 2 or 3 hours, and eventually see a doctor who will give you a prescription for some type of medicine. Before Teladoc, that was the only option. A better solution is to call up the doctor on the phone. You could explain your symptoms to him or her. If the problem is obvious enough, the doctor could diagnose it and give a prescription over the phone. Teladoc put together a network of hundreds of doctors with various specialties. If you feel sick, you could call them and they will be immediately able to connect you with one of their doctors. The doctors are registered in your state, so they have the authority to write prescriptions which you can pick up at your local pharmacy. The doctors who work on Teladoc's network are not employees of the company. They're instead independent contractors who get paid per consultation. The pay usually ranges from $20 to $50 per hour. While that isn't a whole lot of money for a doctor, it's a great source of additional income. For example, let's say you work at a rural hospital, and on some days nobody comes into the hospital. As a doctor, you're just sitting at your desk all day, wasting time. You can pull out your computer and do a Teladoc consultation for 15 minutes and get paid $30. It's a pretty good gig. In fact, Teladoc is often referred to as Uber for doctors because the platform functions in a very similar way. In the US, healthcare is usually provided by employers, and this is a major expense for them. Teladoc's strategy is to target large corporations. They'll pay a fixed monthly fee per employee to gain access to Teladoc's network. Once they're on the network, an employee can call a Teladoc doctor at any time for a flat fee of around $50. In the early years, they had a lot of success signing on massive employers in the state of Texas, such as AT&T. Employee health insurance is a big expense for them, and they're always looking for ways to save money. While they do have to pay fees to Teladoc, it's much cheaper than going to the hospital in person. Any way to minimize the number of hospital visits will save a lot of money. In fact, the consulting firm Willis Towers Watson estimated large employers in the US alone could save $6 billion annually by utilizing telemedicine services like Teladoc. A quick word from today's sponsor, Private Internet Access, or PIA, which is my VPN of choice. When you use PIA, your traffic is securely routed to one of their servers around the world. Once you connect to one of their servers, your IP address is hidden and your data is encrypted. This protects your identity and keeps your data away from spammers. Also, you can virtually change your location to any of the 75 countries that they have servers in. This allows you to bypass geo-restricted content, such as when you're watching Netflix or other streaming services, or access websites that are blocked in your country for whatever reason. They have over 20,000 servers, which means that you always get fast and reliable internet access. You can even use one subscription to protect up to 10 devices at the same time. Signing up for private internet access is risk-free, as there's a 30-day money-back guarantee. They've partnered with us to give viewers of this channel 83% off, plus an additional 4 months for free when you use the unique link in the description below. This equates to just $2 per month to protect yourself online. And now back to the video. Teladoc IPO'd on the New York Stock Exchange in 2015 as the first pure-play telemedicine company to hit the public markets. They used their IPO proceeds as well as additional capital raises to fund an aggressive growth-by-acquisition strategy. They acquired dozens of smaller competitors to become the largest telemedicine company in the US by far. They also developed a video conferencing solution, kind of similar to Zoom. This makes it easier for patients to show their symptoms to doctors instead of having to describe everything verbally on the phone. While Teladoc's business was already growing rapidly, the pandemic was a huge boon. In early 2020, non-life-threatening doctor visits were postponed, so the only way to talk to a doctor was with telemedicine providers like Teladoc. Also, there was a general fear around going to the hospital for fears of catching COVID. As soon as the pandemic hit, their revenue started exploding exponentially, and to date it has almost tripled. As a major COVID beneficiary, Wall Street fell in love and the stock price increased 3.5-fold to almost $300 per share. In the summer of 2021, they took advantage of their high share price to acquire another digital healthcare company called Livongo in an $18.5 billion mega deal funded mostly with stock. That was the largest digital healthcare deal in history by far. Livongo is a software company targeting diabetes patients. You can put your blood sample into a Livongo machine to test your blood sugar. The blood sugar level is uploaded to your online profile so you can monitor its trends over time. Their platform connects you to medical professionals who can advise you about lifestyle changes and improve your diabetes situation. Both companies' revenue growth and share prices benefited tremendously from the pandemic. This is because both help people fulfill their healthcare needs without having to physically go to the hospital. After the Livongo acquisition, Teladoc became an integrated telemedicine provider. They can integrate the Livongo data with their Teladoc platform. If you're a diabetes patient using Livongo, you show your Livongo blood sugar data to the Teladoc doctor, which helps them to better understand your medical situation. It's not unreasonable that Cathie Wood saw this as the Amazon of healthcare. With their software and video medicine solution, they are disrupting the $4 trillion US healthcare industry and expanding internationally. Their total addressable market could be unimaginably large. Okay, everything we've talked about so far sounds great. But then why is the stock down almost 90%, wiping out close to $50 billion of shareholder value? In fact, Teladoc's current market cap of $6 billion is just 1/3 of the $18 billion that they paid for Livongo just a couple years ago. That's a pretty insane number. The combined entity of Teladoc and Livongo is now worth just 1/3 of what Livongo was purchased for as a standalone company. So what happened? While their revenue growth has been impressive, they have yet to report a single quarter of net profitability since they went public back in 2015. Also, their shares outstanding has increased exponentially as they issue more equity to fund their cash burn in numerous acquisitions. This might seem odd. All Teladoc has to do is operate the platform. The fees that they charge patients and employers is much higher than what they pay to doctors, so they earn very impressive gross margins of almost 70%. The problem is that it's a very competitive industry with low barriers to entry. While Teladoc is the biggest operator by far, there are many small and regional telemedicine providers that they must compete with. To land customers, they spend exorbitantly on sales and marketing, which prevents them from achieving net profitability. This is the same reason why ride-sharing and food delivery companies are mostly cash-burning machines. There are very little direct costs associated with operating the platform, so you might think they would be profitable. But there's so much competition that they are forced to give very generous promotions both to customers and drivers. During the Fed-induced growth stock bubble of the COVID era, investors were willing to overlook lack of profitability if revenue growth was high. Now that the Fed is raising rates, investors want profits now, and they have very little patience for high-growth cash incinerators. On April 28th, Teladoc released an earnings report which briefly caused the stock to lose almost half of its value, falling to a low of $29 per share. At face value, the earnings looked like a complete disaster. They reported earnings per share of negative $41.58. Their losses from the first quarter alone were greater than their entire market cap. That's pretty shocking, and you might be inclined to think that losing more than your market cap should drive the company to bankruptcy. But it's not as bad as it looks. The vast majority of this loss was caused by a non-cash goodwill impairment related to their acquisition of Livongo 2 years prior. Remember that they purchased Livongo for $18.5 billion. Based on the technicalities of merger accounting, most of this purchase price was recognized on Teladoc's balance sheet as goodwill, which is an intangible asset. It's basically saying that since Livongo is now part of Teladoc, the value of Teladoc should incorporate the value of Livongo, which is ostensibly $18.5 billion. Clearly, now that Teladoc's market cap is only $6 billion, it would be absurd to say that Livongo is still worth $18 billion. That's why they had to write it down. The goodwill write-down isn't really that big of a deal. What was a lot more concerning was their disappointing revenue and profit guidance for 2022. They say that they expect $2.45 billion of revenue, which represents a 20% increase over 2021. While not horrible, this is much lower than the 86% growth that they recorded in 2021. They also expect to make slightly negative EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This means the core business will still not be profitable, even when you strip out the non-cash impairment charge. CEO Jason Gorovich blamed the weak guidance on increasingly fierce competition. Their Google search ads are bearing less customer conversions as they compete with smaller regional competitors, especially in the direct-to-consumer space. Direct-to-consumer means an individual signs up for Teladoc directly, not through their employer. However, on the enterprise side, they're still doing pretty well. They recently won a large contract with Northwell Health, which is the largest hospital system in New York. Teladoc's large scale makes them more attractive to large employers and hospitals, making them a near monopoly. But on the consumer side, they don't have much of a competitive advantage. The low barriers to entry means that net profit margins will be driven below zero by intense competition. But if they can starve out their competition, they will be extremely profitable. Teladoc already has over $2 billion in annual revenue. If they can't even turn a profit yet, it's a pretty safe bet that their competitors are losing money as well. These small competitors have their losses funded by venture capital investors who were happy to throw money at them when interest rates were zero. Now that money is no longer free, the venture capitalists will be far stingier, and a lot of these small firms could go bankrupt. As a publicly traded company, Teladoc has a huge advantage. It's much easier for them to pay their employees with stock-based compensation. While that is dilutive to the equity value, it reduces their cash burn and should help them stay afloat until they reach profitability. Seeing as they already make 70% gross margins, they should be able to achieve profitability at some point down the road. The decline of Teladoc's share price can be partially attributed to the Fed raising rates. But in the long run, this may benefit them by driving their smaller competitors out of business and leaving Teladoc as the last man standing. Will Teladoc be the next Amazon like Cathie Wood says? Probably not. But with the share price down almost 90%, the bar is not set nearly that high. Despite the disappointing guidance, they're still growing and they're approaching break-even on EBITDA. This video is not financial advice, and I personally have no stake in Teladoc at the time of publishing this video. But I will say this: if you buy shares today in the 30s, you're at least better off than Cathie Wood, who is buying them last year for almost $300 a piece. Alright guys, that wraps it up for this video. What do you think about Teladoc? Do you agree with Cathie Wood that it has the potential to be the Amazon of healthcare? Or do you think it's just an overhyped call center for doctors? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.